We'll be focusing on 5 main points. The first point is going to be the moat. It's basically the advantage of a company compared to its peers. Second one, market and the opportunity. Third one is going to be management and governance. Fourth is going to be financials and efficiency. Fifth, and the last one is going to be the valuation, looking at the metrics. I wanted to act like a senior equity research analyst, and specialization should be detecting high growth companies. It's going to have a 100-point analysis on a ticker, and I wanted to analyze 5 main points that I mentioned at the beginning, give us a final score. The first one is going to be the moat. It's basically the defensive durability. Like, what is the advantage that company has? And to do this, we need to first focus on a few points that I'm going to mention. The first one is going to be switching costs. For example, in Salesforce, if a company is using Salesforce, they're buying product from them, how difficult it is to switch that product, how dependent they are to Salesforce, for example. And I'm going to give it to between 0 to 2 points. We'll be looking at network effects. Is the product getting more valuable as more people are using it? For example, Visa, if more people accept it to use as a payment method, for example, that means the more customers is going to come. So that's going to affect the company. Another point is proprietary IP. It's including patents, trade secrets that legally block competitors. For example, NVIDIA chips, they have so many patents that other companies cannot reproduce the same products and just sell it on the market. Brand power, the ability to charge more simply because of the name. And Apple is a great example for that. Even though Xiaomi phones are competing with Apple, for example, Apple is just selling its name. Counter positioning. Netflix is superior to Blockbuster because they're heavily relying on physical stores. Another point is economics of scale. Being so big that your cost per unit is lower than anyone else's. Because Walmart is buying a massive amount of volume so that competitors cannot deal with that, and that is leading to selling those products in a cheaper price. Data advantage is quite important as well. Using unique, vast data sets to improve the product in a way others can't. For example, Google search. When you're searching for something, you're only looking at Google. It is helping Google to improve even more because it can obtain more queries. That means better decisions. Regulations and distribution mode is also quite important. For example, Union Pacific government is protecting their deals so that no other company can build railroad tracks across the US. It's protected by law. Culture of the company. And the last point in the first section is going to be the pricing power. It's the ability to raise prices without losing customers. For example, Louis Vuitton, their customers are already they know the brand and they're going to buy the brand just because of the name. Second part is going to be market and the opportunity. The TAM size, for example, total addressable market, is how big the market can be. For example, 20 years ago, robotics was a small market, but right now it's becoming bigger and bigger. And that means, for example, NVIDIA at the moment is $4.5 trillion. To have a high growth effect, it needs to reach market cap of $45 trillion. It's not very possible within 3 or 5 years. Another point is compound annual growth rate. It's, for example, cybersecurity. The demand is increasing because every year the security is becoming a more issue. And it's a good indication those companies are going to be in need. Another point is secular tailwinds. Aging population can be a good example to that. United Health or Oscar Health, they're increasing in value just because of these reasons. Path to leadership. Is the company already number one, or do they have a clear path to become number one? Disruption level is also another good indicator. Is the company is replacing an old school industry like Airbnb? They are just a bridge between people who wants to book an hotel who are providing accommodation. Mission criticality. CrowdStrike can be an example to this. It cannot just turn off their security software during a recession because it's the main point why they're providing this service. It should be up and running. You never know when the attack is coming in terms of security in software. Recurring revenue, and the world is shifting to this way. Adobe is a good example to this. They were like selling one product for $500, for example, but now they switched to $50 subscription per month so that they can estimate what is upcoming in the next 6 months or in the next month even. Companies should have international runway. Are they only succeeding in one specific region or one specific country, or they can expand their products globally? McDonald's, they have burger restaurants all over the world. Third point is going to be management and governance. Within this point, ownership is playing a huge role. If the owner knows what they're doing, they can act accordingly. For instance, Mark Zuckerberg, even though Metaverse was a failure, but he still has some insights about the market. Execution track record. Does management have the capability of doing what is needed? We can take Jeff Bezos as an example. Capital allocation efficiency. How wisely are they spending their money? Are they doing buybacks? If a company is doing buybacks, that means they trust in themselves, they trust in their products. R&D, are they improving the current product? Nvidia, for example, even though they are the monopoly, they are still improving their products. They're focusing on better chips, better performance, and better ways to solve AI problems. And being customer product focused. Rather than focusing on short-term goals, they're focusing on user experience, like Costco. They refuse to increase the price of pizza or hot dog just because they're acting like they promised it's going to be this price for a longer period of time, and they're still doing it. So transparency or resilience. This is quite important as well. Everyone can make a mistake. If a company is making a mistake, they need to be transparent. Admitting those mistakes, taking actions accordingly, executing those goals, short term and long term, is a good indicator of a company, because if it's giving us how they're handling the risks, how they're handling the bad situations. Employee sentiment is a good indicator as well. Happy employees usually lead to better products. They're going to stay there longer. They'll be happy with what they're doing. Nvidia's employees, for example, it is consistently ranked one of the best companies to work for. And the last point of this section is going to be mission-driven DNA. Are they only focusing on making money, or they're trying to be the best in their field? Fourth section is going to be financials and efficiency. This is the engine room. This is where we are analyzing the financials. And the first one is going to be revenue growth. It is about how fast the top line is expanding compared to last year. If the company's revenue is growing at 30% year to year because they are gaining superiority in the market. Gross margins is playing a huge role as well. Software as a service companies is a great example. Often they have 80% gross margins, like more than 80%, because it costs very little to deliver the software to the next customer. They don't need to build a new building that is going to take like 2 years, for example. Free cash flow and return on invested capital, because cash flow generated and how effectively they reinvest profits. Are they taking the profits or are they reinvesting the profits? ROIC of 20% means every $1 reinvests, they generate 20% in profit. It's a great sign of high quality compounder. And we need to be checking for rule of 40 score. It's the combination of growth rate and profit margin. A score above 40 is quite good. If a company is growing 30% with 15% profit margin, has a score of like 45, it's a great indicator of a healthy, balanced growth. Net revenue retention is one of the good places to look at. Even though they're not increasing the amount of customers they have, their customers are increasing the usage. They are buying more. Even though they didn't sign up any new agreements, their revenue can still grow because current users are demanding more from them. In high growth stocks, balance sheet net cash is probably going to be minus. If they have something positive, it can affect our decisions. And monitoring stock-based compensation can be a good way of checking it. If a company grows 20%, but it's only giving 10% shares to their employees, basically their share is getting smaller. And operating leverage. This is when revenue grows faster than operating expenses. If a company doubles its sales, but its rent and head office costs stay the same, profits explode. And this has a direct impact on the net cash that we mentioned above. And the last section is going to be valuation, the margin of safety. Relative valuation versus peers and history. Is it cheap or is it expensive compared to its own past and its rivals? If a stock usually trades at 30x price to earnings ratio, but is currently at 15%, it may be a good deal to buy. And another thing is risk reward symmetry. Is the potential going up is bigger than potential going down? Then this might be a good place to look into. Buying a high quality grower during a market panic might be the good time to buy certain stocks. And the output requirements is going to be executive summary. Is it a bull case, a bear case, a scoring table, a clear table showing every subcategory, the score assigned, and one sentence justification for that score. The third part is going to be high growth verdict. We are focusing on 100-point system. Points between 90 to 100 is going to be S tier. And I specifically asked for this. What are the key risks? Identify the top 2 factors that could lead a permanent loss of capital. And we'll be using our own judgment to decide, is it the risk worth taking? On top of this, we need to provide some data because these large language models, they're using RAGs, like retrieval augmented generation. And it's just retrieving data from web. Just to eliminate the bias, instead of expecting LLM to pull data from web, we'll be providing our own data. We'll be providing income statement, balance sheet, cash flow, major holders, and insider transactions. And I'm going to show you how. You're opening up Yahoo Finance website. It's a free website. You can just Google it. When we search for a certain stock, let's search for Archer Aviation. On the left-hand side, we are seeing financials. Income statement. The first data we're going to feed into is going to be income statement. We are expanding all, we are copying everything, and we are pasting it to our prompt. The second one is going to be the balance sheet. We're clicking here, expanding all, taking everything, and just pasting to our prompt. Cash flow, we're doing the same. And then holders. Major holders, we're just copying this part and pasting it to our prompt. And insider transactions. I'm only interested in the last 6 months. We are only copying this part. I'll be using Gemini. I type this prompt and this is the result I get. Archer Aviation, deep dive equity research analysis. It's giving us the bull case and bear case. It's giving us the scores depending on the sections. Financials, valuation. The total score is 52. It's an F tier, for example. But this is not enough. We need to also focus on market sentiment. What people are talking about in Reddit, in trading platforms. We should take them into account as well. This is the end of it, guys. Thanks for watching it. I can also build an MCP server. You can automate this process and you can just deploy it. If you're looking for such a thing, just let me know. I'll see you in the next video.